welcome to our tutorial on 30 August 2025, tutorial which will mainly deal with the unit number 8 and unit number 9. Those are the second last two items or units, meaning we're almost done with our curriculum. Before we go too far, I want us to look back on what has just happened, or reflection on what we've already done from unit number 1 and unit number 7, or the assessment itself that we have just recently wrote, or we wrote last week. I want to check those who wrote the assessment. How did we find it, and what were the areas where we battled, or what did we battle with on the assessment? Let's see by the raise of hands.
I wrote the assignment. So for me, it was not that bad, but somewhere I messed up not my calculations, because the actual answers were correct, but I placed them where they're not supposed to be. So I just need to tell you, on my chapter 7, there and there, but otherwise it was good.
Sorry. Yes, no, we had you, Patu. Thank you so much. I was just making a follow-up on chapter 7, so meaning you need to brush up the credit transactions.
Yes. And then the other thing is, I also requested there was a survey that was sent. I requested that at least can you get, like, as we're doing these sessions, can you get like difficult examples? And we did the example, but that example was quite easy. But when you go to the assignment, we get something much deeper. So maybe if you could go do an examples that are a bit difficult, so that you can be able to wrap your mind around the whole concept of deep diving into the examples.
Oh, thank you, Patu, for that. I think we did get that kind of feedback in not the previous one, the other class, and you will see with what we're going to look at today that we'll try to balance. But of course, being difficult must also accommodate those who are saying whatever that we do is still difficult, because you would have noticed that when we are doing those items that you consider to be basic or easy, there are still others who will still be not understanding in that regard. However, we will try and keep that balance so that we can accommodate those who are excellencing and those who are struggling.
For me, it was not that difficult. I think if, say, you can give us more time on my side, I don't know if that is possible.
You mean more time to write?
Yes.
Unfortunately, the time provided is more than enough. And remember, more especially when you're doing accounting, we're not only teaching you the debits and credits accounting. There is a bigger lesson as well in terms of time management. But we'll talk about it, I think, not in the next class, the class after the next one, in terms of some of the tricks that we can use in order to better manage our time, because time is always a problem. And unfortunately, that is the area where you are being pushed to as well, to say, as an accountant, you must have the capability to manage your time. You must have the skill of being able to do things while you don't have enough time. You must be able to produce those reports when you don't have enough time, and you will see it when you get to CTA level or the postgraduate level, that by then you will be used to it, that will always not have enough time, and you will figure out how to pass with the limited time. Okay, thank you so much, colleagues who have shared. Let's move on to look at the last week. Not last week, this week, we're looking at two main aspects, which is unit number 8 and unit number 9. However, I do not want to dwell much on unit number 9, mainly because it's a revision of what we've already done on unit number 3. However, I do understand that there are those who might still be struggling with that content. So I will just quickly and or slowly demonstrate how everything linked together up until the trial balance. And basically, this is exactly the class that we're going to do after next week on unit number 10 and unit number 11. It will be again the repetition of what we have done in unit number 3 and unit number 9. So unit number 9 is mainly dealing with the trial balance, and it seems like my documents are not showing me what I want to see. Unit number 9. Aha. I hope you are able to see my screen. I will try to make it slightly bigger as well. Trial balance is something which looks like this, where on top up there it has the company name, and it's a trial balance at 31 January 2023. I want to emphasize this. The word "at" there, it's very, 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 very important. When you go further, if you write trial balance for the year ended, or for the month ended, or trial balance for the financial year, or write something else which means something else, you may have challenges in terms of the earning and or losing marks. So that word "at 31 January" is very, very important. You will see next week, after next week, when we deal with the statement of financial performance and financial position, as to how important is how we name these items, because they do have a meaning. And if you write something else, it would mean something else. However, at your level, at the first level, and sometimes at second level, we're not really pedantic about that. However, it's important that you note that. So if you look on the trial balance, it has the debit balance and the credit balance. The debit balance and the credit balance. The meaning is still the same that we have been teaching from unit number 1, and they're all the accounts inside here. These accounts, sometimes we call them GL accounts, or general ledger accounts. All the accounts that are in here. I will start from the beginning again. I was just showing you from the end. All the accounts are here. The principles of which ones are assets, which ones are liabilities, which ones are equity accounts, which ones are income, which ones are expenditure accounts, they still apply even here. And that determines whether the amounts go on the debit side and whether the amounts go on the credit side. However, there are accounts that can go either way. They can be on the credit side and they can be on the debit side. A very good example is the bank account. I want someone to tell us, to volunteer to tell us what makes the bank account to have a credit balance. Let's see those who know, but the rest of hands. What makes the bank account to have a credit balance? Let's see by the rest of hands.
I'm not sure, but I think it will be having a negative balance.
And what does that mean?
It means on overdraft.
Yes, thank you so much for that. I was looking for that word. So we all know that you can have an agreement with your bank that sometimes I run out of money, and when I run out of money, I want the bank to allow my balance to go to negative, and they do your credit assessment and determine how far on the negative your account can be able to go. If they give you 100,000, it means your account can go up to negative 100,000. So once your bank balance go below zero and goes to negative, or you are now owing the bank instead of you having money in the bank, then that's when your balance went on negative, and that's when you will find the bank account having a credit balance. So from us, we'll tell you that this company had a bank overdraft, or it has a facility or overdrawn facility, or we'll just show you the balance with a negative, or put inside the brackets. If the balance is inside the brackets, it also means it's on the negative. The other account which goes to which can either have positive or negative balance, it's mainly the SARS, which can be receivable or payable depending on whether you owe SARS or SARS owes you. And you know, when you do your tax return, SARS can owe you money that they refund you if you are an individual, but if you are companies, it works slightly different. However, it's possible that SARS will owe the company money, and most companies, they owe SARS. On the individual side, that's where most of the time the SARS owe the individual, but most companies, they owe SARS, meaning when companies owe SARS, it will be on the credit side, and when SARS owes you, it will be on the debit side, and in this instance, it's on the debit side. It means SARS owe us as BS cleaners. So I will quickly run through the whole process. This is the end, almost the end, the whole process from the beginning up until the end, so that we can then have a bigger picture on how everything links together. We will recall on the very first module, where we spoke about the accounting documents, the receipts, the invoices, and everything, and we had the list of transactions, business transactions that happen. So these are the transactions that will happen within the organization, and when these transactions happen, they have to be recorded. First thing first, we record them on the journal. We call them subsidiary journal books. Subsidiary journal books. Go cash receipts journal, cash payments journal, sales journal, sales returns, purchases journal, etc., etc. So just very quickly, I will only look at the highlighted transactions. The first one is transaction number 3, which we have already done 3 times already in the past in 3 different classes, which says on 2 January 2023, TUT students brought their laundry to BS cleaners and paid 5,000 rands, including VAT, for washing their clothes. So in the past, we've already agreed that when you are recording these transactions in the subsidiary journal books, because we have received money from our customer and it's cash for rendering the services, this will go to the cash receipts journal. So we'll go, I'm opening the cash receipts journal now. We'll go on our cash receipts journal, and we'll go and record that transaction. I've just highlighted it. I'll try to make it bigger. When I'm making it too big, it's closing other things. We'll record that transaction on the cash receipts journal. Document number 003, the date, it was on the 5th, from TUT students. The folio transaction number 3, we said it's 5,000 rands excluding VAT. There is 5,000 rands and we have recalculated our VAT as by 5,000 by 15%, it became 750, and what we take to the bank is 5,000 rand, which is exclusive VAT plus VAT, which is 5,750. There is 750 that we've recorded. That is that transaction. So I'm showing you where that transaction was recorded. Let's go to the next one. The next one is transaction number 4. It says BS Cleaners bought the cleaning material for 20,000, and this amount exclude VAT. This amount exclude VAT. They've bought the cleaning material for 20,000, and this amount exclude VAT. So we have bought cleaning material, meaning we are purchasing things, and we are purchasing on credit, meaning the purchasing journal will be used to record that particular transaction. Where is purchasing journal? Purchasing journal, there it is. We said we bought for 20,000, and we said 20,000 does not have VAT. There is the transaction. I'll try to make it bigger. I will try to make it bigger. We said 20,000 does not have VAT. There is 20,000. How do we calculate VAT? We say 20,000 times 15%, which is 3,000. There is 3,000, and there is the total amount which will go to payables, which is 23,000. And then next transaction. I think there was an error. I don't know if anyone has noticed. On the one we just did, this is VAT exclusive, not inclusive. So the next one is payment of salaries. Ms. Bisitole has been utilizing a sister to assist her in cleaning services. She has paid salaries for 4,000 rands, and she has paid cash, meaning this is cash payment journal. We'll go to the cash payment journal. There is the transaction of payment of salary, which is 4,000 rands. And salaries do not have VAT. Employees, when they work for a company, they don't charge the company VAT, so there won't be VAT on the salaries. There is our cash payment journal, and the amount is 4,000 rands, and we'll put it on salaries 4,000 rands. And last one, where is the last one? The one of petty cash. I don't think I highlighted it, but anyway, here it is. Transaction number 7. This is the one which Patu needs. Ms. B. Sitole withdrawn 5,000 rands from the bank account and keep the cash on the cash float box to replenish petty cash. So the director of the company has taken money from the bank account, cash, and put it in the petty cash box. In practice, this transaction is almost like a transfer of money within the account, two accounts, an account called bank and the other account called petty cash, where bank, because it's decreasing and it's an asset account, it will decrease on the credit side, and the petty cash, because it's also an asset account, it's increasing, it will decrease on the debit side. So minimum credit bank and debit petty cash with that particular transaction. In practice, more or less, that's how it happens. Or whatever you do on the system, transfer or credit, whatever that your system calls it, in the background, in the general ledger, that's what it will be doing. So here, this is one of the few transactions that we will record them twice, mainly because it affects two different subsidiary journal books. The first one is the cash payment journal, because we're paying cash, where it was recorded the 5,000 rands there. We are, don't mind my petty cash misspelling there, where we are petty cash, it's being paid 5,000 rands, and we put it under the sundries and indicate that it's petty cash on the cash payment journal. And on the petty cash journal, there it is the money which is coming in. On the receipt side, there it is, where, let me make it bigger. On the receipt side, we are indicating that we are receiving the money of 5,000 rands on the receipt side of the petty cash journal. And yeah, I think I will not go through all the transactions, just selected these 4 that we will have a look at. So now when you are done recording your cash receipt journal, cash payment journal, and petty cash journal, sales journal, purchases, general journal, and general journal. So now you go and have totals in all your books. Cash receipt journal, it means you will have the total for the bank column, you will have the total for all cash receipts can have as many as possible. You would have noticed that. You can have the totals on your service rendered, you can have the totals on your sundries, even though on the sundries it's not necessary to have the total, because these accounts are different individual accounts which you will need to record them separately. And cash receipts journal, it's similar and or the same. You will have the totals of your bank, your petty cash journal is the same, sales journal is the same, and the purchases journal is the same, and general journal is the same. So when you are done having the totals, even general journal, even though general journal is similar to those others, most of the transactions are individual transactions, so total, it's not that much meaningful. I'm saying that so that the person who spoke about time management, meaning when you are now writing, the ones that you're not going to do anything with their totals, my advice would be don't even bother to calculate those totals, because chances are that they won't even have marks for that matter. Even if they have marks, they will be very minimal. If you have a mark, you will spend 20 minutes calculating a total here on the general journal, while you're going to have half a mark, and then you lose 20 minutes, which you could have used to earn 30 marks elsewhere. So the accounts and books that have totals that are meaningless, that you're not going to use them in future or somewhere when you are writing, my advice would be try to avoid wasting time in calculating those totals. So you have seen general journal, it's not necessary to have the totals, because you're not going to use it anyway. The purchases journal, of course I didn't do the totals because we only had one transaction. There is no need to have total. So even when you are writing, there is no need for you to come and waste 30 seconds transferring these amounts here and make them totals, because believe me, there won't be marks for transferring amounts from up here to down here, while there are no other, only when there are more than one transactions. And sometimes, I know we have done, most of us who have done mathematics a while back and at school, when you just look at the transactions, where there are easy mathematics that you can do, there is no need for you to use the calculator. Just have a look at it and put the total there. Believe me, even if you have missed by 20 rands, we might not necessarily penalize you for that, provided that we can see that when you are moving forward, you are carrying forward the total that is coming from that particular total field. So just like this one, when you just look at it, you can almost guess how much more or less is going to be your total there. Some of them, even this one, when you just look at it, can already say 7.5 and 750 and then you are done. Even that one, if you were to do the total, you can already see that this is 107. So there's no need to always use the calculator in that regard. So when you are done totaling your subsidiary journal books, Then you go and create the general ledger accounts. I've already created them. So these general ledger accounts, they are informed by what you have. Let's use cash receipts journal as an example. On the cash receipts journal, the general ledger accounts that are relevant here, then the ones that we have their headings here, meaning we'll have the bank account, we'll have the service surrendered account, and the ones that are on the sundry, we'll have the capital account, we'll have the interest income account. So these are the accounts that will be affected on the general journal. The very same goes to the cash payment journal. Means we'll have the bank account, we'll have the equipment account, we'll have the salaries account, we'll have the VAT account, and the one that is on the sundry. The very same goes to the sales journal and any other. The tricky one is the general journal part. General journal, unfortunately, it works slightly different. All the accounts that are mentioned inside here, we must have their general ledger account. But most of the time, we'll tell you which general ledger accounts you need to open. For me, if we say open a bank account, for me, now when you are doing the totals, you only focus, you will only do the total for the bank account because that's the only one which you're going to use in future, but we'll tell you which ones. However, for demonstration purposes, note that on the general account, all these accounts that are written inside here, they will then have to have the accounts and they will be opened. And on the general ledger or the GL, there is the bank account. So I will use 3 accounts to demonstrate the ones that I've highlighted: the bank account and the services surrendered account. On the bank account, I'll try to make it bigger. Sorry, that's too big now. Yeah, I think that's big enough. So this is the general ledger or the GL bank account. You can see it as the debit side and the credit side. That's what's most important. Of course, in a normal circumstances, there will be balance brought down, which is the balance coming from the last time or the previous reporting period, and the balance carried down, which is the balance which we are carrying down to the next reporting period, and we repeat the balance carried down, we repeat it as balance brought down, which is we're saying we'll bring it down in the next reporting period. You can see I have written CRJ here. This 112750, it means this is the total column from the cash receipts journal. I'm going back to the cash receipts journal now. Cash receipts journal, there it is. The total column of the bank account, there it is, 112750. I'm going back to the general ledger. On the general ledger account, the money from cash receipts journal, there it is debited. The reason why it's being debited, remember, bank is an asset account. Assets account increase on the debit side, and all monies that are increasing the bank account, they get debited on the bank account, and all monies that we've recorded on the cash receipts journal, they are cash that we've received in our business, which goes to the cash receipts journal. Let's move to the cash payment journal. Cash payment journal also has a bank account. There is the total 43,500. Let's go back to the general ledger accounts. Cash payment journal, there is the amount of 43,500. This is the total for bank side. So this goes to all other accounts that we're going to look at. Meaning, if you open the cash payment journal, it has an account called equipment. So meaning this will also go to the equipment account called salaries. This will also go to the salaries account called VAT. This will also go to the VAT account. Sorry, I'm pointing the wrong figures. The totals there, they will also go to the salaries and the VAT account and everything. And on the sundries, this will also go to the account called petty cash. That is how general ledger accounts work with the subsidiary ledger books. And then the slightly difficult one is the general journal. I'm just opening the general journal quickly. This is the general journal. Let me make it slightly bigger. general journal. Remember, this is where we record all the transactions that could not be recorded in the cash receipts journal, cash payment, purchases returns, sales returns. Any transactions that could not be recorded there, they get recorded here. So there was an interest which one of the suppliers has charged us of 500 rands, which we've recorded with debited interest expense when we credited payables. And however, the one I'm interested on is this one. There is a supplier that we have paid 2,000 rands, and that transaction we agreed last time that it will be recorded in the general journal. But what I want to demonstrate is that we have debited trade payables, so meaning on the general ledger there is an account called trade payables, which you will see this 2,000 rand, and we will also credited the bank account, meaning on the general ledger I will show you now there is a transaction which has credited the bank account, which I'm opening the general ledger bank account. There is that 2,000 rands which is coming from general journal. So the difference between general journal and all other books is that all other books mainly use totals and what is included in the sundries to transfer to the general ledger. But on the general journal, we use transactions individually, transactions that are coming from inside. Then other one is trade receivables, where we have debited bank. I think we received money from someone who owed us 3,000 rands, and we've agreed that it will be recorded here. The bank was debited and trade receivables was credited, and then it means on the bank you will see on the debit side the 3,000 rands. There is the 3,000 rands that is coming from the general journal. I've also inserted formulas here so that you will be able to see exactly where these figures coming from. And when we're done, services rendered is the same. This is coming from the cash receipts journal, the 5,000 rands from the cash receipts journal. There is a column called services rendered, that's 5,000 rands, and that is the 5,000 rands coming from cash receipts. There are another 5,000 from sales journal where we sold something on credit. Sales journal, there is the 5,000 rands which is coming from the sales journal, which is in there. Second last thing that I will emphasize here is that, or third last thing that I will emphasize is that all these monies that we are seeing here, they are excluding VAT, all of them. They are excluding VAT. I'm talking about the interest and whatnot. I mean the income and expenditure accounts, they excluding VAT and or whatnot. And the ones that are on the balance sheet accounts, the income and the assets and liabilities accounts, they do include VAT. However, you would have already dealt with that when you are recording them here, because remember, this one does not have VAT, this one does have VAT, but you would have already dealt with them. I'm telling you that because sometimes,
Mr. Katu,
yes,
Mr.
ma'am.
Katu, sorry to disturb you. There are two comments on the chat. They say you are too fast. It looks like they are not catching up. It's Wendy and Patu. Sorry.
Thank you for that. Thank you for that. I think maybe we'll oh no, Patu said we are doing too simple stuff. Fella, this is basic as well. But anyway, let me try to slow down. I will just quickly summarize so that we can repeat. Patu, I will give you a chance to speak, not so long. Or maybe let me allow you to speak, Patu.
The stuff that you're doing is fine, but the pace that you're going at, it's like you're just reminding someone that already knows, like, okay, go back to general, take this, and then come here, take that, like, I'm even lost, somewhere I'm lost, because you're just going there, okay, we're going to take this balance, put it there, take this one, put it there, like, I'm even, I don't know.
Yes, no, thank you, Patu. Yes, it is the revision. We've already done this from unit number 3 and unit number 6. However, I will give you a chance to highlight the areas where you're not quite comfortable with. So what I wanted to indicate was that sometimes you will be allowed, in fact, sometimes you will be required to jump your subsidiary books, your cash receipts journal, cash payment, and all these things. We will give you the list of transactions, the ones that I have here, and say, go and record these transactions in the general ledger. So meaning you are jumping book, cash receipt journal, and others. So that will mean you will immediately come and debit and credit those transactions directly on the general ledger account. Sometimes you will be asked to record those transactions that way. Second last, I will repeat again very quickly though, in the interest of time. Second last, these books, as I've said before, the general ledger accounts, all the books must be closed. Remember, the assets and liability accounts, they will have balance carried down and will carry it down to the next reporting period, of which on the bank, this is very, very important. On the bank, when you are balancing it, because it's an asset account, it means it must have the balance carried forward that will be carrying over to the next reporting period. What you could do, that will be before you have these figures. What you will do, you are going to compare the debit side and the credit side and see which one is the bigger than the other. You can see the debit side is 115,000 and the credit side it's 45,500, meaning the debit side is bigger than the credit side. Then your total will be the bigger one, which is 115,750. You put it both on the debit side and on the credit side, 115,750. Then, because the account must balance, it means you are short of some money on the credit side. Then you will take your balance of 115,750 minus 2,000 minus 43,500, or minus the total of the credit side. Then that's when you will get 70,250, and that amount you also write it on the debit side, on the opposite side, let me put it that way, on the opposite side of where you have it, and you call it balance brought down, and you are going to brought it down on the next reporting period. And when you brought it down, you'll write it somewhere up here just before this, the very first figure. That's how you balance all the assets, liabilities, and the equity accounts. Let's move to the so meaning this is how we will do for all. Capital, you will do the same. Unfortunately, I'm not going to do all of them because of the interest of time. Capital, your VAT works slightly different. Your petty cash, your equipment, your trade receivables, payables, you will do similar things when you are balancing them. So the income and expenditure accounts work slightly different than everything else, of which we have used sales or services rendered as our example. Sales, remember, we had two transactions, the ones that were totals from the cash receipt journal and totals from the cash payment journal. And we'll do the same here. We compare the debit side and the credit side to see which one is bigger. The credit side has 10,000, the debit side has 0. So meaning the credit side is bigger than the debit side. That's where you will then come and use 10,000 as your total. Then, because the debit side will be out of balance, you will then have to put the amount which is short. Meaning we're going to say the total of 10,000 minus 0. Then it becomes 10,000 rand. And this is where the difference is. All income and expenditure accounts, they get closed off through the profit and loss account, which is the profit and loss account. This will also open as another general ledger account. It's not necessary unless if you're asked to do that. Another general ledger accounts and call it profit and loss. So when we are done closing off all these general ledger accounts, that's where the trial balance kicks in. I started with the trial balance so that you will see the whole bigger picture. So now we're moving to the trial balance. Guess what? On the trial balance, we list all the accounts that we're having from the general ledger. The first, there is bank, trade, receivable, petty cash, equipment, all these transactions that I have, all these accounts that are having the T accounts here: bank, capital, service rendered, VAT, data. So VAT works slightly different. The VAT input and VAT output, will notice that they got closed out on the SARS account. But if you look at it, it's very much straightforward on how they work. They get closed out here, so you are only going to report the SARS account. SARS, petty cash, interest, all these accounts, you come and list them here on the trial balance. And you take their balances as they are from the general ledger, you come and plug them here. And these balances, it means if a bank is having the debit balance on the other side, let me just open the general ledger quickly. General ledger, bank account. The balance that we're carrying forward, it's on the debit side, it's 70,000. It's on the debit side, it's 70,250. The principles are the same on all of them. The income accounts, we all know the income accounts will be on the credit side, and the expenditure accounts, all of them will be on the debit side. When you are done, you add all your debit side and all your credit. This is one of the areas where the balance matters, and you have to do the balance. And exemptric. I would not advise anyone to spend 2 hours trying to calculate the total year. We have all done mathematics. More or less, you can see how much could be the total at the end. Please do that and have a total. And unless if you are done and you finished, you have time, go and use the calculator and add your totals and have the total at the end. But ideally, your total must, your debit side must, and the credit side must add up. Then that's where we arrive at the trial balance. I was showing you this so that you can have the bigger picture of how do we move from the list of transactions up until the trial balance. So I will repeat, trying to be very quick but very slowly in the interest of time. First thing first, there will be the transactions. I've opened the transactions now. List of transactions to say who has done 1, 2, 3, who have bought this, who have sold this, who have paid this, who have done this and that. That is the list of transactions. And sometimes instead of telling you in words this, we can just give you an invoice. Here it says we've bought a cleaning machine for 30,000 rands, and it includes VAT, and we've paid via EFT. You can draw a nice EFT slip and say we have paid in 30,000 rands, or we draw you an invoice, draw you a nice invoice there and put it the way in which we will get it from the shop. But the essence of the matter will mean the same. But the wisdom from it, you should be able to figure out where is the total amount, where is the VAT amount, where is the VAT excluding amount. Unfortunately, on the class, our art is not that much good. There is someone who I think suggested that we should try and draw as well. Unfortunately, our drawing is not that much good, and the technology to do that, it's very much time consuming. But for the purposes of our learning, we'll just tell you. But on the assessments, we'll draw and try to design those invoices for you so that we'll be able to see what is happening. But the principles on how to interpret and work on those is the same. As long as you know what is an invoice, what is a cash receipt, what is a sales cash slip, what is this and that, as long as you understand what is happening, then you will be fine. So after these transactions, like I said, this transaction must be recorded on the cash journals. The very famous first one is the cash receipts journal. We'll come and record all these transactions here on the cash receipts journal and record and say whatever that we are talking about. We've done 1, 2, 3. Record all those transactions that qualify to come to the cash receipts journal. Cash payment journal will do the same. Sales journal, petty cash journal, up until the end. When we are done, that's where we are going to do the general ledger accounts. This is the ones that I spend a little bit of time on because I know they're very, very important for accounting purposes. General ledger accounts, bank is one of them that we have used as an example. And we take the totals from all those subsidiary books. Remember what I said about the different one is the general journal, where we take individual transactions and record them on the general ledger. And we take all those, we record them on the general ledger accounts, or the T accounts. I think the strict language for them is the T accounts. The T accounts are these ones. Record them on the T accounts. When we're done, we balance them. Remember what I've said, assets, liabilities, and the equity accounts, we balance them this way. The ones that have balance credit down and balance brought down. And remember how to balance them? We compare the total from the debit side and from the credit side and take the bigger one. The bigger one, we use it as the totals at the bottom. Then we say the total minus the total of the smaller one. Then we put it as a balance credit down. Balance credit down, we take it forward to the balance brought down in that regard. The income and expenses account, I've indicated that the difference is that we close them off through the profit or loss account. And when we're done doing all these accounts, will come and list them on the trial balance, the one that we have started with and we are ending with. All the accounts, come and list them, and depending on whether they are having debit or credit balance, come and put the amounts on the right side where they are supposed to be. So in essence, that's how it all gels together. So this is the summary of unit number 9. Unit number 9, of which, is there anyone who is having a big challenge in understanding something from the big picture? Let's see by the raise of hands. No hands. I guess we have done justice to the bigger picture. So we're moving on from unit number 9 to unit number 8, where my calculated time was supposed to be 1 hour 15 minutes, so 15 minutes behind. However, we'll see if we'll be able to catch up, or we'll look at it very high level so that we'll see the big picture. So unit number 8 deals with the bank reconciliation statement. This is not difficult, but the tricky part of accounting, because in order to do the bank reconciliation statement, you must understand in the main everything else that we've already done, more especially the cash receipts journal and the cash payment journal. You must be the master of those two accounts. You must master cash receipts journal and cash payment journal and understand the bank account in the main in order to do the bank reconciliation statement. So if you're still starting with those two, you will have a bigger problem. However, it's not difficult, it's just tricky. If you spend time looking at it, you will be able to get it right. And most of the academics, when they are making jokes, accounting jokes, they usually use the bank reconciliation statement to say, these are the, I'm summarizing, these are the instances where you can find a chartered accountant who cannot do a bank recon. As a joke though, the reason why they use that as a joke is because this is one of the trickier or the most tricky item that you will ever find in accounting. However, if you spend your time on it, you will be able to master it. So we'll look at the components, the common concepts. We'll look at the bank reconciliation statement. We'll look at lastly, we'll look at the assessment, which is currently coming. Let's start with the common concepts. I have them, I think they're big enough. I have them on the screen. Let's see by the raise of hands who would look at these 2, 4, 6, 8, 9. Look at these 9 items. Raise your hand if there is something that you do not understand what it is and what it does in accounting. Please raise your hands. I will give you a second to look at it. I'll give you 30 seconds to look at it and raise your hands. Please tell us the first three. Explain in layman's language the first three as to what is the bank charges, what is the debit orders, what are the direct deposits, and for accounting purposes, how do you handle those? Or for bank reconciliation purposes, how do you handle those?
Okay, I'll start with the bank charges though, but I'm not sure. I'm just guessing. The bank charges, I think it's the one that the bank charges you, like for maybe withdrawal, paying debit orders, or any money that you will be sending to other person, I guess.
Yes, that is correct. And accounting purposes, what do you do with bank charges? Or for bank reconciliation purposes, what do you do with bank charges? You're not sure. So the bank, you just said or maybe before I intervene, go on debit orders.
The debit order is like paying the account phone or maybe the DSTV account. When that money is going out of your account, the bank is also charging you for that.
Yes, not really bank charging, but bank is paying on your behalf for that. Yes, I agree with you. And the direct deposits?
That one I'm not sure about.
Okay. No, thank you so much, Ms. Lakum. Bank charges, you are right. It's when you are using the bank, the bank charges you some items there, which is your, like for example, if you have a check account on a monthly basis, there is a check account fee, which the bank will charge you. The most famous one, I think, is 500 rands. Most banks, they hover around that, or on average, most people, they pay around 450, 500 rands for a check account every month. So that item, the bank will charge you that 500 rands or whatever amount for the bank charges. Sometimes, if people deposit money in your bank account, deposit cash in particular, we all know some people, they say cash is expensive. So if someone deposit cash in your bank account, the bank will charge you the cash deposit fee. That amount there, that is the bank charges, and it means you are paying for the bank charges. And we all have just said not so long that when we are paying for things in cash, you record those transactions on the cash receipts journal. Cash payments journal. Cash payments journal. Cash payment journal. You are recording all the amounts that you are paying in cash. The next one, debit orders. You have said it right. Debit orders is when you are paying for things. You are paying for items that, of course, you have subscribed to, but you are not really paying directly. The bank is paying on your behalf. The bank is paying on your behalf, and either the phone, the bond installment, or whatever that the bank is paying on your behalf, that is the debit order. So when you are paying for something and you are paying for cash because your money is coming out of the bank, that is the cash payment journal where we record that. Direct deposit, which you said you don't know, the direct deposit is when someone deposits money directly in your bank account, meaning you have received money. So meaning maybe one of your customers is settling whatever that they owe you, or they're buying goods and services, they go and deposit money directly in your bank account. That is the money that you have received that goes to the cash receipts journal. Who wants to tell us the middle three? Interest charge on the overdraft, interest earned on the positive bank balance, mistakes or omissions made by both the entity and the bank. Who wants to tell us what are those and how do we handle them in accounting wise or in the bank reconciliation statement? Tell us, and Level wants to know what are the interest charged on overdraft and what are the interest charged on positive balance, and what are the omissions and or mistakes made by both the entity and or by the bank. What is your understanding of those three items? Interest charged on the bank account, the errors made interest charged on positive and interest charged on negative, mistakes and omission made by the entity and the bank.
Okay, interest charged is money that they charge you for the money that I think you borrowed from the bank. Like as you use it, they charge you. Like I'm not really sure.
That's correct. Yes, yes. Interest on overdraft. Remember, we have explained earlier on that the overdraft, it's when your bank account goes to negative, and when it goes to negative, it means you owe the bank that money. When they charge you interest, meaning they're charging you that interest. And for the bank reconciliation purposes, what do you do with that interest?
Yes, I'm not sure.
You can, because it's cash that you will have paid to the bank hypothetically, that you can take it to the cash payment journal, and such transaction also qualifies to go to the general journal, but cash payment journal. And the other one, interest and
on. So it's when, for example, like if you have money that you're saving like with the bank, for as long as you still have the money there, you still get your interest, but like there's like a certain percentage of interest that you will earn every month for keeping the money there.
Yes, and when you have earned the money, where does it go for bank reconciliation purposes?
Ish.
You are receiving money, remember, cash receipts journal, but these are the transactions that also qualifies to go to the general journal. So cash receipts journal, the bank is giving money for keeping your money, so it's money in cash receipts journal. And then this is the bigger one now, where your colleague Lebogang Sibanyoni also said she wants to know what is that. Mistakes or omission made by both the entity and the bank. What is that? Muslaho. Oh, sorry, Mutepe, sorry. Mutepe.
Mistakes do happen like when people are like recording transactions. For example, if like you put like an extra zero on an amount, or you record like an incorrect amount, like if there's like the last digit is missing or the first one. So like maybe if you like have like a typing error. If that happens while recording a transaction. So it can either happen by like either from the bank or you, and then you can see it like on your statement, I think.
Yes, that is correct.
Yes.
Yeah, so even though on the bank side, it's very rare for the bank to make mistakes. I'm not saying it's not possible, but I'm saying it's very rare. But thank you, Mtepe. So mistakes do happen. Mistakes do happen. Mistakes can happen on our side as the company most of the time, and or on the bank side. Very rarely so. So let's start with mistakes from our side. If we have made a mistake our side, we are the ones who need to correct the mistake. So the bank reconciliation statement, see it as something that we are doing to almost like rewrite our bank statement, and things that need to be corrected by us, they don't go there. They remain with us on our subsidiary books, which is your cash receipts journal, your cash payment journal, etc., etc. So we correct them there. The mistakes that we have made, we correct them there. And mistakes that were done by the bank, let's say, for example, most of the mistakes in practice is that there will just be some money which someone has deposited in your account, which you do not know who is this person and what is this money for. Most of the time, entities, they tend to pocket that money. However, for the purposes of learning, we are not, and when they pocket, they're not really stealing it, but they just assume that now probably it's one of our customers. This is an amount, in inverted commas, this is an amount which is a misallocation, or a person has put the wrong reference number and stuff like that, and entity will have an account which deals with it. But for the purposes of learning, when you have some money that you don't understand or don't know what is it for on your bank statement, you flag that amount on the bank reconciliation statement and make follow-ups with the bank so that the bank can reverse that money so that it can go to the rightful owner. For accounting purposes, that is the principles. I know your company might be handling it differently. Please, that's the one of the few areas where you will have to carry an academic hat on the other side and slightly forget about the practical hat, unless if we have told you otherwise. But on these debatable issues, we barely put any assumptions in. We just stick to our academic side, or to say, if you have received the money and you're not sure what it is for, that is a reconciling item on your bank reconciliation statement, and you record it on the bank reconciliation statement. We'll talk about which side does it go and what not later on. It's very easy to deal with it. We'll deal with it not so long. And lastly, who wants to, before we go to the example, who wants to tell us about the last three? The outstanding deposits, the outstanding payments, and the stop orders. Who wants to tell us what are those?
So I will tell you about the two. The last one, I'm not sure about it. So I'm gonna tell you about the outstanding deposits. So this will be the deposits that the entity would have made to the bank, but they're not reflecting yet. And then the outstanding payments, it will be the payments that were made by the entity to maybe to supplier or whoever, but they haven't been, the amount haven't been subtracted from the bank yet. Like sometimes it will say maybe pending, or it will not show at all. It will show maybe the following day or something like that.
Yes, no, I agree with you. I think outstanding deposits and payments, they are very identical. Those monies that we either have deposited to our account, or we have, we have paid on our account, and we have recorded them on our cash receipts and cash payment journal. However, they're not yet reflecting on the bank, on our bank account. And these are the amounts that we will then record on our bank reconciliation statement. Because remember, we have done our part, or everything looks right on our part. The bank is the one which is at fault, in inverted commas, or which has not yet done what they need to. Majority of the time, this happens. Deposits in practice, very, very rare, unless if there are errors. But payments, more especially if you have paid with a credit card, there is something called banking that the vendors, or wherever way you swipe with the card, they must do process those batches where the amounts will then reflect on your bank account. Most of the time, the vendors that are using FNB and customers that are using FNB, you'll remember that, or notice that when you swipe on the toll gate, you will swipe your card, and money will not be going out same time. Sometimes when you have even forgotten that you traveled to Durban, after 3 weeks, you will be surprised by SMSs or notifications from the bank that, hey, money out. You have swiped at Tonga to tollgate, money out. You have swiped at Mukopane, money out. So most of the time when you have paid with the card, that's when the payment gets slightly delayed, and it reflects later on. So on the bank reconciliation statement, it means when inside you would have swiped, and whoever was swiped would have brought the receipts in finance, and finance would have recorded those transactions on the cash receipts journal. On the cash payment journal, and but they don't reflect on the bank statement as yet. Then that's when you will record these transactions on the bank reconciliation statement. Stop orders. This is where we instruct the bank in the main to say, bank, on a monthly basis. Stop order is very similar to to the debit orders. Similar concept. However, the debit orders, the supplier that you owe is the one who would have sent the instruction with your consent instruction to the bank to say, please pay, please take money from this person's account and pay me. And stop orders, it's us who are telling the bank to say on a monthly basis, please pay this particular person. Nowadays, with internet banking, in the olden days, you literally walk to the bank and tell the bank that can you please pay this account or pay this particular person on this date every month and this much. Nowadays, with internet banking, the things that are called future dated payments or recurring payments that you make on your internet banking, that's exactly what the stop order is referring to. It's an instruction to the bank to say on this particular date every month please pay this particular supplier or this particular other bank account. Sometimes individually stop orders, if you hear a person say I have a stop order of 5,000, what they actually mean is that maybe they have a savings account and that's very controversial. Let's say maybe they have a check account and a savings account. Check account, that's where they get their salary and that's where they pay for their day-to-day expenses. They have a separate savings account and they go to the bank and say, please bank, take money from my check account, take 5,000 from my check account to my savings account every month when I get paid on the last day of the month or something like that. So that will be the stop order. So more or less that's how the stop order works. Similar to debit order, and the implications are the same, cash payment journal, because it's money paid. So I think we have covered the bank reconciliation in overall by just looking at these common concepts. However, to emphasize that indeed we do get the gist of what we're expected to do, I will open the Excel example, which I hope we have all had time to look at it or to do it. That is our bank reconciliation statement. Can you see that the structure more or less looks like your general journal? You see, the only difference is the heading there. Can you see? Bank reconciliation statement for the month of March. And let me also re-emphasize the fact that the bank reconciliation statement, depending on the company policy, it can be prepared at any time. For most of the companies, they do bank reconciliations. Bigger companies, they do it daily. There will be a person who deals with the bank on a daily basis. And nowadays with AI and the systems, there will be an AI, what do we call them? A GPT which deals with the bank reconciliation or on a real-time basis. So daily there will be a bank reconciliation statement prepared. Smaller companies, they usually do it on a weekly basis. Every week there will be a bank reconciliation statement, but the principle is the same regardless of when they are done. And sometimes it's done on a monthly basis. These are very small micro companies that do it on a monthly basis. And for academic purposes, we are going to do bank reconciliation statements on a monthly basis. So don't be surprised if you see another bank's reconciliation statement on another intervals that is not monthly. The principles is the same. It's just a difference in terms of the recording intervals. So I've already prepared the template for cash receipt journal, cash payment journal, and general general ledger, the bank account. Let's go to the question though. Unfortunately, in the interest of time, we are not going to finish everything that is listed here. However, the simple stuff will run through it, and the difficult stuff we will dwell much on them in detail and have a discussion, and those who are having different views on how different things work will then talk to it. Just another reminder, this is the tutorial. What tutorial means is that I give you the question in advance, you go and do it. After having done it, we come and meet in a tutorial class like this, and then we only discuss areas where you would have had difficulty. However, we do understand that there are people who could have gotten stuck and didn't even know where to start. Hence, we'll try and do everything. However, the easier ones will run through, the difficult ones will dwell much on them and do them in detail. So this is a very basic, I think Patu will hate this. This is a very basic question which I took from DBE. DBE means it could have been a metric question from DBE. Those who have done accounting in metric, meaning you might have seen this before. DBE, bank reconciliation statement question at a very basic level. However, basic questions are very important in highlighting principles that will then apply when you are dealing with the difficult questions. Another exam trick here. At your level, please start by reading the required before you go too far, so that even when you are reading the question, you are knowing what exactly you need to focus on. Our requirements are 3. The first one, it says complete the cash receipts journal and cash payment journal for March 2020. When you see this required, what does that mean? It means go and create more or less a structure of the cash receipts journal and the cash payment journal, of which I've done that. I'm opening those structures. That is my structure of cash receipts journal, and that is my structure of cash payment journal. Those are the two structures. The second one, it says prepare the bank account. When we say an account on 31 March 2020, when we say account, we mean the T account or the general ledger account. There is my bank account where I've created the T account of the bank account, just the structure G, so that when the transactions come, I will just slaughter them in. Number 3, it says prepare the bank reconciliation statement for March 2020. There is my bank reconciliation statement for March 2020. I just prepared the structure without anything before I go to the transactions. All clear, I guess. Then we'll go to the information which we are given. What I want to also emphasize, the bank reconciliation statement, more or less, things that have to be there. You will have the bank balance as per bank statement. Majority of the time, if the bank balance, it's a favorable balance, on your bank statement it will be called credit. It's going to sit there. We're going to have the balance not so low. It's going to sit there. And we will also have the bank balance as per the general ledger. Majority of the time, if your bank balance it's a favorable balance, it will sit on the debit side there. On the bank statement, the reason why, and this is where it makes the bank reconciliation statement tricky. The reason why it sits on the credit side, it's mainly because, remember, the bank is also a business, and it does have people whom it owes and people who are owing it. If you put yourself in the shoes of the bank, people who have money in the bank, those are people that you owe them that money. So meaning that's a credit balance in their eyes. and people who are owing the bank in the eyes of the bank. Those are the people who, in the bank's eyes, they're the bank's debtors. That hence you will find the debit balance issue. That's where it kind of tricks most people's minds, and you get confused as to why this one's going on the credit. So what happens here? It's almost opposite of what would have normally happened in the normal running of the transaction. So the bigger picture is that we are trying to reconcile the bank statement balance and the bank balance from our general ledger. These two balances, they will never be the same, and we are recording transactions inside to try and reconcile them so that they can be the same. And how do we do that? We're taking the balance from the bank statement, and transactions that would have increased our bank balance, we are going to credit them here as our credit bank balance is sitting on the credit. Our favorable bank balance is sitting on the credit side. And transactions that would have decreased, meaning the payments and the likes, would have decreased our bank balance in the bank. We are going to record them on the debit side because those are the transactions that would have decreased the bank balance. At the end of the day, all the debits plus all the credits, we put them down there as the totals. And when we say our bank reconciliation statement is balancing, it's when the two balances are balancing. So let's continue with our transactions. Number one, they say on 31 March 2020, bank account in the general ledger reflected a balance of 11,300. Who wants to tell us where we're taking this balance? They say the general ledger balance is 11,300. Who wants to tell us where we're taking this balance? So colleagues, since it seems like we're struggling with the basics as well, I think let me walk one step backwards. When we are doing the bank reconciliation statement, generally we would have already recorded all our transactions in the cash receipts journal, in the cash payments journal, and in the general journal. Then we will receive the bank statement from the bank. And what we'll go and do is that the bank column of both the cash receipts journal and the cash payment journal, we take those columns and compare them with the transactions that are reflecting on the bank statement and tick. I think on your learning material, you see that exercise happening. And tick, 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 meaning ticking transactions that are appearing in both, that are on the cash receipts journal and that they're on the bank statement, tick, tick. Those ones, we do nothing with them. The very same goes, transactions that are on the cash payment journal and they're also appearing on the bank statement, we tick, 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 tick. The very same goes to general journal, even though general journal will barely use it for academic purposes. But the principles are the same. If there are transactions that are affecting bank on the journal account, we tick them against the bank statement as well. And at the end, we then now look at the transactions that are on the bank statement and not on our cash receipts and cash payment. Put them aside, and also look at the transactions that are on our cash receipts and cash payments, but they're not there on the bank statement. Put them aside. So in principles, what you are seeing listed here on this transaction ABCD is interpretation and or explanation of those transactions that we are now putting aside. And we all know when we're discussing the main concept, we all know that transactions that are on the bank statement but not on our cash receipts and cash payment, we'll go and record them in our cash receipts and cash payment. And transactions that are on our cash receipts and cash payments but they're not there on the bank state on the bank statement. We go and record them in the bank reconciliation statement. We use an example of a credit card in that regard. So bank reconciliation statement is basically doing that. And of course, there will be errors and what in and between. But errors for me is just an explanation of why it is not there, or it's this side and not on the other side. So here on A, they're telling us before these other transactions, the balance on our bank account was 11,300. So what we need to do with that 11,300 is just to record it on the general ledger, and they've already told us that is a debit balance of 11,300. On the general ledger on our bank account, meaning 11,300. I'm not going to copy to write the other the other items, the descriptions items and everything in the interest of time, because I know we're not going to finish, but we must handle the details. We'll just put the balance there and we'll move on. The second transaction, this material was distributed to everyone somewhere around last week, if not beginning of this week. I think beginning of this week. And my assumption, like I said before, is that we would have went and try and do this, and we'll discuss areas where we'll get stuck. So they're telling you provisional totals, provisional meaning before these transactions that are underneath. Provisional totals from the cash journal says 31 March was on cash receipts was 66,000 and on cash payment was 58,500. It means exactly that you must go and plug them on the cash receipt journal and then the cash payment journal. 66,000 and 58,500, meaning cash receipt journal, there is your 66,000. They said it's provisional total. And cash payment journal, they said 55,800. 55,800. It's also the provisional total. Sorry, 58,500. 58,500. 58,500, not the other way around. 58,500. Just the provisional totals that they've given us. And they say the following information on the March 2020 bank statement received from HL Bank did not appear in the March 2020 cash journals. This is almost like giving away. Like we said just now, we said items that are appearing on the bank statement, but they're not appearing on the cash receipts and cash payment. We record them where? Who wants to tell us where we're recording these transactions? Items that are on the bank statement but not appearing on the cash journals. Who wants to tell us?
I think we will put them on the general ledger.
No, Pato. Let's do an example. They say a deposit. Someone was paying rent to our company of 9,600. Where do we record that?
Deposit from. So it will be.
Remember, this is the direct deposit, which you said it's almost like money that we are receiving, but it's being received directly from the bank through the bank. Our customer is paid directly in our bank account. Ntswako mogoto. So ntswaki mogoto. Okay. So colleagues, this is very simple, and I think we are complicating a very simple matter. Things that are on the bank statement and we have not yet recorded them. What needs to happen? We just need to record them. And we are recording them on the cash journals, meaning either cash receipts or cash payment, because the bank only deals with cash receipts and cash payments in the main. It's either cash receipts or cash payment. It's either it's money in or money out. Money in, cash receipts, money out, cash payment. So definitely tell us when our tenant has deposited 9,600 in our bank account. Is it money in or money out?
It's money in.
And money in, where does it go? Cash receipts or cash payment?
Cash receipts.
100%. So on the cash receipt journal, which is here, we're going to record the 9,600 that we have received from whoever for the renter. And then let's continue. Daphne, I see your mic is still on. Maybe tell us even the next one. Debit orders. Remember we said debit orders is just a fancy word of the bank paying things on our behalf. They are the debit order, town council, insurance, what. Is it money in or money out, Daphne?
It's money out.
And money out, cash receipts or cash payment?
Let me see.
Money out, we are paying. Cash
Yes, it's money out.
Is it cash receipts journal or cash payment journal?
It's cash payment.
100%. Colleagues, can you see how easy this thing is? Can you see how easy this thing is? So the very same goes for all the transactions up until the end. Others, they just have EFT, all these fees, EFT fees, cash handling fees, service fee. These are, we've already spoken about. I'm not going to record this because these are the simplest part. These are all the bank charges that we spoke about earlier on. And bank charges, it's what the bank has charged us, or essentially we have paid the bank these monies. They all go to the cash payment journal. And then there is interest on favorable balance. We just spoken about this earlier on. Interest payment on favorable balance. This is the money which the bank has given us for keeping our money with them, meaning it's money in cash receipt journal. Deposit from debtor, K what for a settlement of his account. This is money in again, receipts. And EFT for 50 reflected on the business bank statement. This payment does not relate to business and must be corrected by the bank. I want someone to tell me about this. They say there is an EFT of 5,555, which was reflected on our bank account. And it was paid by someone who do not know, and it has nothing to do with us. How do we record this? This is an error on the bank side now. There is someone who also asked that we must talk to the errors, even though I will add something which is not here, which talks directly to the errors before we end. Where does this go? An EFT of 555. What do we do with the EFT of 555, which was reflected on the business bank statement and does not relate to the business, or we don't know what it is about?
I believe the money goes to the bank. Is that correct?
Where? We have four things there here that we're doing. Cash receipt journal, cash payment journal, general of bank reconciliation.
I think the bank consideration.
Bank reconciliation, yes. That is correct. The 555 will go to the bank reconciliation statement. Are we debiting it or are we crediting it?
I think we're crediting it.
Why are we crediting it, Leva?
No, actually we're debiting because it's money that we can't account for, so it's going to the bank straight.
it's money that we can account for it and is going to the. You are right. We are debating it, but I don't agree with your reasoning. The appropriate reason. Remember, we would be having money here, the bank balance as per the bank statement here, and essentially, that statement is saying on this balance we have 5,555, which does not belong to us, which is not ours, meaning ideally we must minus it from this balance. So hence we are minusing it, meaning debiting it, because our bank balance is sitting on the credit side. Hence we are debiting it and putting it there on the debit side. So we are trying to reverse the amount which is there, which was not supposed to be there. Hence we are debiting it. That is the appropriate reasoning, to say this amount, let's give it a figure. It's not anywhere. I'm just giving it a figure. Let's call it 70,000. This 70,000, it includes 5,555, which is not supposed to be here because it's not ours. Then we are debiting it. And then D, they say the following information in March 2021 cash journals did not appear on the bank statement for March 2020. These are the transactions that, when we were comparing our cash receipts journal and the bank statement, we realized that these transactions, we have them on our cash receipts and cash payment, but they're not there on the bank reconciliation statement. What must we do with these transactions?
So I think we're going to have to record this in the bank reconciliation and credit the account, the bank.
Yeah, your first statement is right that we must record them in the bank reconciliation statement. But your statement of crediting is very dangerous, because remember, this includes items that are coming from the cash receipts and items that are coming from the cash payments, and they're not all going to the same side of the bank reconciliation statement. So the first one, outstanding deposit.
Sorry, I was
yes,
talking. I was talking about the outstanding deposits of 21,000.
Oh, okay. No, I thought you were talking about all of them. So yes, the outstanding deposit means it's 21,700. It means on the bank reconciliation statement we're saying this balance of 70,000, it was supposed to have an amount of 21,700, which we did not see on the bank statement. So we must then come and put it inside. We're crediting it. We're saying the 70,000 does not have the 21,700. Then we are putting in the 21,700. The very same goes to they say there is an EFT 223 of 7,200. EFT is a payment, 7,200 to DD traders for trading store, meaning we have paid 7,200 for trading store. We also paid 2,896 for stationery, but these are payments. They are not reflecting on the bank statement. What do we do with them? Similar to what Pato has just said. We are going to record them on the bank reconciliation statement, but let's start with 7,200. 7,200 were paid for stock, but we're saying it's not there on the bank statement. Meaning we're saying this 70,000 is, it does not have 7,220, which we have already paid. So meaning the 7,200 has not yet been minused on this balance from the bank statement, meaning on the debit side, that's what we're going to put the two outstanding amounts, which is 22 7 to 20 7 to 20 and 2896 2896, because what we are saying here, the reasoning is very, 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 very important. What we are saying here is that this balance of 70,000 does not have this amount. And if it does not include the payments of these amounts that we've already paid. And if we've already paid, it means it was supposed to be minused on this balance. And if we are minusing here, it means we post on an opposite side, which is the debit side. Hence, we have posted what you are seeing there, that we have posted. And lastly, they want us to determine what is the balance according to they want us to calculate the balance as per the bank statement. Unfortunately, we're not going to do that, but that is now not necessarily accounting, it's more of mathematics, if I can put it that side. So you will try to redetermine how much would have been the balance from the bank statement in that regard, of which ideally the balance as per the bank statement, you will then go and sum up the debit side and have the total, and assuming that the debit side is correct, then you take the debit side minus whatever the total will be on the credit side. Then you assume that that will be your bank balance as per the bank statement. But majority of the time, we're going to give you the bank balance as per the bank statement. So when you are done with all these transactions, you will have recorded everything on the cash receipts journal and cash payment. We didn't record everything, we just did examples. We record everything on the cash payment journal. So what we're going to do, you're going to have a total from the bank accounts. Let's call it 30,000, 70,000. Let's call it 70,000. We're going to have 70,000 total here. Cash receipts generally, we're also going to have a total here. Let's call it, because there would have been other transactions that we didn't record, the simple ones that we didn't record. Let's call it 100,000. So when you are done, you will take the total from the cash receipts journal, the 100,000, and the total from the cash payment journal, the 70,000. We'll come in to record them here. That's what we've just done when we're doing revision. Cash receipts journal, the 100,000 will come here on the debit side, which is coming from the cash receipts journal, and cash payment journal, it will come to the credit side, and we said it will be 70,000. Remember, how do we balance the ledger account? We look at the debit side and the credit side and determine which one is bigger. In our case, the debit side is bigger, which is 300, which will be our total. The debit side is bigger, and it will be our total. Triple 300. The credit side is smaller. And how do we balance a bank account, which is an asset account? We'll come and say the 300 minus 70,000, which is the total of the smaller side, which is the credit side. And remember, we call this balance carried down. And we take the same amount of 1,300 and we create it to be a balance brought down on the next reporting period. And for the purposes of bank reconciliation statement, we take this amount for 1,300, we take it to the bank reconciliation statement. Balance as per the bank balance as per the general ledger. It is that balance which we have just calculated on the general ledger when we are balancing our accounts. And then at the end of the day, we must sum up the debit side and the credit side. Ideally, the debit side and the credit side must be the same. Unfortunately, ours, because we have omitted other transactions, they're not going to be the same. And again, the good part is that our question has asked us here. what is the balance according to the bank statement as at 31 March, of which the balance as per the bank statement, you are going to take the total on the debit side, which is 56, and minus the total on the credit side. That will become your balance as per the bank statement. Most of the time, we are going to give you both this balance and that balance. We're going to give you the two, or we'll give you the top one, the one from the bank. Majority 100%, 90% of the time, we'll give you the balance from the bank, and then this one will have to redetermine using the cash receipts and cash payment and the bank GL account as you have indicated. Then you add the credit side as well, which it should balance. The debit side and the credit side should be balancing. That's when we say our bank reconciliation statement is balancing. Lastly, someone said I must quickly talk about errors. Lastly, within a second, very high level, depending on who has made the error. He who has made the error must correct them. So meaning, if the error is in the bank, meaning the bank is the one which has made an error. Like for example, we had a transaction here. Which said an EFT of 555 was reflected on the business bank statement, and this payment does not relate to the business and must be corrected by the bank. The bank is the one who has to correct the error, meaning this goes to the bank reconciliation statement, and we've already recorded it here in the bank reconciliation statement. And if it's us who have made the error, let's say we say someone has omitted to record whatever a transaction, we must correct the error on the cash receipts and or cash payment journal or general journal at very selective, very minimal circumstances. So cash receipt journal and cash payment journal, if we are the ones who have made the error, we must record those errors in those accounts. And whether the amount goes to cash receipts and or cash payment, the thinking around it is whether are we required to increase or reduce our bank balance. If the correction of error, we are required to increase the bank balance, we are recording the difference of whatever amount, the error amount in the cash receipt journal. If the difference, we have to decrease the bank balance, we are recording whatever amount of error on the cash payment journal. What the typical example could be, for example, let's say we have received 100,000. We have received 100,000. I'll just call it correct. And we have incorrectly recorded it in the cash receipts journal as 120,000. If we have received 100,000 and we have incorrectly recorded it in the cash receipts journal as 120,000, it means our bank balance it's having 20,000 more, which is the difference between the two. Our bank balance is having 20,000 rands more. And how do we correct an error? It means we must reduce the bank balance with 20,000. It means this 20,000 we are going to record it on the cash payment journal because we are reducing what we have already recorded. On the cash payment journal, we are going to record the 20,000. And if it was the other way around, meaning if if the correct amount was 120,000, but we incorrectly recorded it as 100,000, what needs to happen? It means we must increase our bank balance with 20,000. Then we are going to record the 20,000 on the cash receipts journal as such. And if the bank is the one which has made the error, the principles are similar. It's just that now, because it's the bank that has made an error, we must record those errors in the bank reconciliation statements. Errors by the bank must correct them on the bank reconciliation statement, and we are going to record them there. The principles is the same. You look at the what exactly is this error correction doing to our bank balance. If it's increasing our bank balance, it means it must be credited. If it's decreasing our bank balance, it means it must be debited on the bank reconciliation statement. In principles, that's what happens, and that's how we need to think around that. Second last, there is someone who says we must assist with the question. Unfortunately, I'm seeing the other assessment. Unfortunately, we are not allowed to assist you with the actual assessments. However, we can talk around the principles around them. So, but I think the question was around the sales journal as to which one is the correct sales journal, which is prepared there on the screen. Of which, for me, I think main thing, you look at the 3 transactions and look at which one. I mean, how would you record those transactions on the sales journal, and look at which one is not having. Oh, sorry, I've put it on a different screen. This is what I'm talking. One of the learners here in the group has posted this transaction that he needs assistance. He or she needs assistance with this transaction. Unfortunately, we're not allowed to assist you with either the quiz and or the assessments directly. However, we can talk around the principles. And I was explaining the principle to say there are 3 transactions that are there, that are recorded there. And in order to figure out which one is the correct and or incorrect sales journal there, you go and almost record the 3 transactions roughly somewhere, and then look at these 3 sales journals as to which one reflects what you have recorded, which then becomes the correct one, and you choose the correct one in that regard. So lastly, we will look at the assessment. We are done with the lesson for today. We'll look at the assessment. It's going to open on 4 September 2025, and it will close on 8 September. Then that means on the next week, we're not going to have a class, because I want to give you chance and or time to do this particular assessment, and it contributes something towards your total mark. I just don't remember whether, I think this is the third one. The third one should be 30% or so, but we will see on tutorial letter 101 what is the exact percentage there that it contributes. It contributes towards your year mark, 30%, I think, and it will be covering everything from unit number 1 up until unit number 9. So meaning you must understand everything. The good part is that the first hour of today's tutorial, we focused on doing the revision of almost everything which touches unit number 3, and they also touches all other units up until unit number 9. However, I think the main focus will be on the bank reconciliation statement. But the bank reconciliation statement on itself, it touches on the cash receipts journal and cash payment journal. So meaning you need to know your cash receipts journal and cash payment journal, and understand how to transfer your totals from the cash receipts journal and cash payment journal to the bank account, and how to transfer the balance on the bank account to the bank reconciliation statements, and understand which transactions get recorded on the bank reconciliation statement and which transactions get recorded in the cash receipts and cash payment journal, which I believe we have done justice today in trying and explain which ones of those get reported there. So we will end here. Colleagues, thank you so much for making time to participate on our assessment. and all the best with your next week's assessment. And I will do and send out the tutorial for the week after the next, meaning for Saturday the 13th. I will send out the tutorial now, 13 September. I will send out the tutorial now in advance so that we can look at it. And the main objective when I give you those tutorials in advance is that you go and do the question, do it, so that when we meet in the class, we only look at the difficult parts of the tutorial. Then I think we will be able to benefit more when we do it that way. Thank you so much, colleagues. We will see you on the Saturday, the 13th, when we deal with the last two modules, which is unit number 10 and unit number 11. And those modules are almost like a revision of everything that we've already done so far. Thank you so much, colleagues. The class is officially adjourned.